All right, y'all. We are now broadcasting internationally, so we're going to get started. I think if everybody's not on, they can come on and catch the rest. But want to keep us on schedule. Want to make sure we get this done in an efficient amount of time. And first thing I want to do is introduce my awesome team. I often introduce them. This time we've got some new members that I'm very excited about, and I'm going to introduce them in a slightly different way. I'm also going to ask for a little favor that you all, I'm going to keep talking even though I see the video is off. You should be able to hear me and the video should be back in a second. So I'm going to do the introductions. Jake Sanders was actually going to do our introductions today. Like a lot of people, unfortunately, he got a positive COVID test today. So please have him in your thoughts and prayers. He's doing fine. He's young and healthy, and I'm sure we'll get through it, but we just want to keep him in our mind. The other thing is, I might say this several times throughout the night, anytime you have questions, go to the bottom, hit the Q&A, please put them in there. At the end, Armin and I will thoroughly enjoy answering any questions that you've got. All right, with that, I will hopefully get video in a second so that I can, we tested this for the last hour and a half and the video worked just fine for the last hour and a half. We tested it on multiple systems, multiple ways, got the professional in here. And I've got full faith and confidence in him, but at the same time, we need a second. I'm going to share my screen, and hopefully that should work for now. And that way I can introduce the team. Okay, so I'm going to start with our great operations team. And we've got 4 people there, a couple that you recognize, and 1 or 2 probably that you don't know yet. Joy and Amanda, of course, have been a staple for years now, give us all a lot of comfort and confidence. The thing that I want to do is talk less about what everybody here does. And I realized today as I was going through this, there is a story behind every single person that works with us. So I'm going to give you a brief story for each one. Hopefully I won't take the whole hour on stories. So some of you have heard the story about Joy. About 4 years ago, Tanya and I got married in my house. You're in my basement right now. And last minute, we thought, we need somebody to just kind of help behind the scenes, grab everything. And a friend said, oh, you need Joy. She's a good friend of mine. Last minute, Joy came on board. And throughout the evening, she was everywhere all the time, doing everything for everyone. And at the end of the night, when I went to get my checkbook to pay her, Tanya was sitting outside talking to her and learned that Joy was getting her financial planning degree from UGA. And Tanya said, well, wait a minute, did you know my husband's a financial planner? Joy said, I had no idea. I just knew I was coming to work at a wedding. So pretty much that was her interview, and she was hired not on the spot, but very quickly after. You can't get a better job interview than that. Amanda has been with us a while now and came from a different route. We decided we needed a director of events and communications, and I reached out to a company, a staffing company, and believe it or not, their response was, we have somebody that is looking for a new job as a director of events and communications, just came from that role at another financial planning firm in Atlanta. That may not blow your mind, but it still blows my mind because there's probably 3 financial planning firms in Atlanta that even have that job. And the fact that she came to us with 3 years of experience, and almost all of you have interacted with her. She's does so much behind the scenes for all the communications you get, the emails, the events, the organization. So I know you have great confidence in her along with us. Leslie is a newer member of the team, kind of a similar story to Joy, but very different. Back before COVID, a little bit over, almost exactly a year ago, a mutual friend in the tennis world said, hey, I don't know if you're hiring, but if you are, you need to talk to Leslie. And I said, I don't know if I'm hiring, but you never know if somebody's good, I'll talk to them. So we talked to Leslie. It was great right off the bat, and we wanted to engage her. I came home, told Tanya about it, and Tanya said, wait a minute, Leslie, I think I just played tennis against her like a month ago. There's a lot of tennis players in Atlanta. And she followed that, not just by saying that they played each other. I won't tell you all the result, but that she just said what a great joy Leslie was on the court, just how sweet she was, how reassuring she was, what a great match it was. So again, just a great interview when you're not even interviewing. And then last on the list, not least, is our newest operations team member is Justin Cabe. He actually came from a friend at church. I was hanging out with some friends. They said, the mom actually sent me an email. His mom sent me an email and said, I don't know if you're hiring, but if you are, you might want to talk to my son, Justin. He's looking for, to get, he's embarrassed. He's in the room and I see him shaking his head. So sorry, Justin, but you need a little embarrassment. So I said, yeah, you know what? I'd like to talk to him. We are looking for a team member, and actually pretty quickly realized he's a great fit. He's the director of first impressions in our Cartersville office, which just went through a great renovation, reopening like last week, this week, and he's stepping right into work there and very excited about that. Sliding up to our relationship managers, another newer team member is Joseph Thompson. Another great story. When we went through the renovation, Jake reached out to Justin and said, we need a place maybe to house the office temporarily, to meet people. Justin, I don't know, picks up the phone book, Google searches, there aren't phone books anymore, are there? And calls a commercial real estate person. And turns out that real estate person knew Jake, gave us some options, but then said, hey, I think he reached out to Jake, said, hey, I don't know if you're looking to hire, but you may want to talk to Joseph. And Jake actually had a relationship with Joseph back in college, but they, were not talking until this third party reintroduced them. And very, very quickly, Joseph is a CPA from Cartersville, great family there, wanted to get more on the investment side rather than the tax side of the financial world. And we all quickly realized that was a perfect fit. So if you're a Cartersville client, I am very excited for you, because I'm also very excited for Joseph and the whole office there. I know he's going to be a great team member. He started January and is a great team member. Dean and Craig kind of come hand in hand. So Dean was a good friend of mine that I've been talking to for a couple of years. And he said, he was a health and fitness guy. You can tell from his picture, can't see his whole body, but pretty buff guy. Was traveling, still does travel the country, talking about health and fitness. And he said, you know what, I'm kind of tired of waking up at 4 a.m, doing the health and fitness thing every day. He's not tired of it, he still loves it, but would really love to do something else. So I said, well, you know what, maybe you want to do some business development for my firm. And we started talking, and about a little bit over a year ago, kicked that off, and he's been off to a great start. COVID slowed him, didn't slow him down, but slowed down the follow through on the client side. But he's done a great job onboarding. And then he brought Craig on board, who was participating in some of Dean's workout routines. And Craig had been in the business, was licensed, was already working with another firm to make introductions, and was excited to meet us and see that we have an independent offering, that we can truly put our clients' interests first. So Craig followed pretty quickly behind. Danny Moore, another great story. Tony Ameson, a client of ours, had introduced me to Danny Moore. He said, hey, I want you to meet a buddy of mine, Danny, let's play golf. So we got together and quickly realized that I actually knew Danny from the real estate world. He worked at Wells Real Estate, which is a big real estate investment company in Atlanta. It was probably the first really large non-traded REIT. So we connected. He wanted to get out of the real estate world, called it the wholesaling world, wanted to work with clients. So he joined our team, and you'll hear a follow-up story to that in a second. Gabe, a lot of you have heard about. He's an affiliate advisor. I mentioned wholesalers when I talked about Danny. Probably about 5 years ago, a wholesaler reached out to me, a different one, said, I don't know if you're hiring, but I got this guy that's looking for a home, and his name is Gabe. So we talked, he came on board. He's been an affiliate advisor ever since. He's actually expanded his business to Mobile, Alabama, working with a client base down there, and is doing really well. All right, I said I was gonna continue the story on Danny. You see in the upper right corner is Cody Moore. So Cody is Danny's grandson. Years ago when Cody was in high school, now Cody's gonna embarrass, and he's not in the room, so I can't see him, but he's probably shaking his head. I'm gonna tell the story. When he was in high school, Danny and Cody's father, Danny's son, said, hey, I'd like you to talk to him. He's interested in investing. So we started getting together through high school and college, and he just really had a passion for the investment world all along. When he graduated college, wasn't quite ready to join our team right away. He had some actually great success in IT sales and payroll sales. And then during COVID, we reconnected, and he was really excited to get into our business, and good timing for me to bring him on. So he is a fully licensed advisor now, also working in the Alpharetta team. All right, the Tommy story. So years ago, a lot of you, well, not a lot of you, some of you know I had a business partner back in 2006, 2007. And one day he said, hey, I used to work with this guy, Tommy, we should talk to him. So here comes Tommy, decided to hire him, have him, he's one of the original people to join our team. And then after I brought Tommy on board, I fired the partner, who actually I've been introduced to the partner by a guy named Patrick Grant. And when I brought that partner on, I let go of Patrick Grant at the time. So Tommy knew at that point to never introduce me to anybody else because he needed to stop the cycle of introductions and then the next person goes. Christina, she's our newest team member in Charleston. Now you know why I want to do these introductions. There's a lot of great new team members. Koki brought her on board maybe 6 months ago or so. She was working with Mario Gabelli as his right-hand woman. Some of you may know the name Mario Gabelli. If you do or you don't, you now know that he was probably, I would say, probably one of the 5 biggest well-known names in the investment world. Very, very great reputation, excellent reputation for money management. She was working side by side with him, was looking to kind of, she was up north, wanted to come back down south and slow down a little bit. So she came to join Koki and enhance the team there with the Charleston clients. Susanna, I hate to say I have the least story behind. I was trying to create a story for everyone. The great story about Susanna is when we merged and acquired the Cartersville office, Susanna was the one, we wanted to keep the whole team, but Susanna stood out as the clients really have a strong relationship with her, a strong bond. They really enjoy working with her and enjoy that connection with her. So we're very excited that she is still in the Cartersville office and working now with Joseph and Justin and Jake in Cartersville. All right, and then the partners of the firm. Armin's a neat little story. He tells it better than I do, but years ago, we're both tennis players, another tennis connection. We were on the court together, and mutual friend, Shireen, who may be watching us tonight, said, hey, you guys need to know each other. One of you is in the investment world, one of you wants to get into the investment world. So Armin shared his interest and how all the years he had really loved investing and loved managing his own money and research. So I said, okay, sounds great. I said, I'll hire you, but I'm not going to pay you anything. And I think about a week later, he came to work for free, and it doesn't work for free anymore, but it was a great start, launched a great partnership, and happily ever after since. Jake, I don't know, 5 years ago, was running into him at conferences in the financial world. We were going to conferences for different events, and we would talk to each other at each conference. Actually, Armin and Tommy first met him at a conference and said, hey, Darren, you got to talk to this guy, Jake. For a couple of years, we stayed in touch. We would talk at each event, share ideas, but neither one of us, really could put our finger on, how and why we should actually move forward and work together until a couple of years ago. I came to him, I said, you know what? I just had, the light bulb go off that should have gone off years earlier. And Jake says both of our wives really knew way before we did. There doesn't have to be a reason when there's a mutual respect and capacity to work together. It just makes sense to come together. So he joined the team a couple of years ago, became a partner last year, and helps run the Cartersville office. And then Koki came on board about 4 years ago. She and I had talked for a couple of years prior to that. I was looking to expand into Charleston simply because I love Charleston so much and love to visit there and needed a good excuse. So she and I met, realized we had a lot in common, both in the nonprofit world and also with investing. We had used the same custodian, had a very similar investment philosophy. It took us a couple of years to figure it out and figure out, exactly how the relationship should work. But we figured it out, and it's been great ever since as well. So with that, hope you got to enjoy meeting the whole team. I am going to hand off to Armin. He's going to kick us off with really talking about where we have been last year, where we're at, and I'm going to tell you the whole agenda. He'll start that. Then he's going to hand off to Koki, who's going to talk about risk-adjusted performance and risk-adjusted returns. I was going to step into that, but then I risk spoiling her thunder, so I'll leave that to her. I'll come back and really have fun talking about the future. How do things look? Are they bright? Are they gloomy? And then finally, what are we doing about the current situation and what we see in the future? So with that, I will leave it to Armin. No round of applause, but thank you so much.
Thank you, Darren. I guess as we get into the meat of the presentation here, I wanted to just say hi to everyone. It's always a little bit strange kind of staring at a camera instead of looking out at your smiling faces. But I'm glad that we have the opportunity to connect via Zoom and deliver this presentation this evening. I want to talk a little bit about 2020, which was, to say the least, very interesting. There's an old Chinese curse that says, may you live in interesting times. Well, we certainly lived in interesting times last year. And the
Keep going.
oh, okay. The stock market certainly went on a roller coaster ride, and we're going to use the S&P 500 to talk about the stock market and how the stock market performed last year.
I need to screen share, sorry. Now you can talk about the chart.
Okay. The chart that we have here is essentially the S&P 500 with some key dates put on there. And these key dates are the key market drivers that we had for last year. And if you look at that, blue is COVID-19, green is monetary policy, fiscal policy, basically the federal government, red is the economy, and orange is corporate earnings. If you look on this chart, starting about February 25th is when it looked like the COVID-19 virus was definitely going to be some kind of threat. And that's really when it started hitting the national news. There was certainly an issue going on in Europe. If you'll remember, Italy was particularly hard hit, and it was just dominating the news cycle. And that is when the markets, for lack of a better word, panicked. And we started seeing sell-offs of just about everything. And as you can see from the chart here, it started to go down precipitously. At the bottom here in March, the markets were just in the tank, particularly as it was announced that we were going to have shutdowns in this country, and the economy was basically going to be put on a lockdown. And when that happened, we basically bottomed out. The markets were down almost 35%, I think, at that point from the beginning of the year. Just a phenomenal and unprecedented drop in the markets. Just had not been seen before. Starting on about March 25th, the economic activities in the country really had pretty much come to a standstill. And people were, I think, starting to worry that we might never recover. And that's when the federal government stepped in. I mean, if you go back to the news cycle and look at what was going on at the end of March, the federal government started talking about unprecedented amounts of stimulus, injecting money into the economy, sending checks to people. We had discussion of $2 trillion of federal money being pumped into the system to get the economy going again. And one of the ways we did that was with the CARES Act and PPP loans. If you remember, the Payroll Protection Program was put in place, and CARES was put in place, where stimulus checks were actually given to people to kind of cushion the fall. And there was a number of things done with unemployment compensation as well. Going back to the chart, we started to recover when these things were announced. And it did look like we were starting to turn the corner on the virus a little bit. The numbers started to come down as we entered the summer, and viruses tend to be a little less active, or at least this one seemed to be a little less active during the summer. And we started to see an easing in the lockdowns. Some of the economic activity came back as people were allowed to go back to restaurants and travel was allowed to commence again. So we started seeing a recovery in the markets. And then we had some earnings, corporate earnings that came in that were surprisingly strong, particularly in web-based and internet companies. They benefited from the virus. Now, there were other companies, obviously the hospitality industry, the travel industry, restaurants, that sort of thing, that were particularly hard hit. But there were whole segments of the economy that actually did better than they had been doing because of the new dynamic that was brought about by everyone working from home and ordering things on Amazon, for instance, or getting the food delivered by Uber Eats, those sorts of things. So those were the kinds of companies that benefited, whereas the companies that required you to go out and mingle, they suffered a bit. So as we entered into the fall, we had the election to deal with. Elections breed uncertainty, and we had another hiccup in the markets. I think that was pretty much driven by that, as well as some of the COVID numbers started to spike again, and we saw the S&P fall off a bit before the election. And starting about mid-November, really, the S&P 500 started to take off. And I think the elimination of the election uncertainty at that point, knowing where we were going in the future as far as the politics were concerned, really helped to steady the markets. And it did look like that we were starting to make progress again on the COVID front, culminating in December with the announcement that 2 vaccines had been approved and would be widely available. And I think that that has led to the current surge that we've seen in the S&P. So all in all, by the time the year ended, the S&P 500 wound up being up anywhere from 17 to 18% if you factor in dividend reinvestment. I do want to talk a little bit, though, about the S&P 500 and a troubling development that really has come about as a result of this dual economy. I mean, if you look at the sectors in the economy, like information technology, financials, and even healthcare, that have done well through this pandemic, they tend, because of the way the S&P 500 index is created, it's a market cap weighted index. That means that the more market capitalization or the more money that you have in a particular company stock, the more it's going to be represented in the index. So what has happened to the S&P 500 over this pandemic is that we've now started to see a concentration of value in that index in really the top names. The top 10% of the index now is the top 10 companies in the index now represent over 30% of the index's value. And the top 5 companies in the index, and they're listed on the slide here. We've got Apple, Microsoft, Amazon, Google, and Facebook. And by the way, Tesla was recently added to the index, and it's in position number 6, so it's not listed on the slide. But this has compounded the problem. But those companies now represent over 20% of the value. Just 5 companies, over 20% of the value of the entire S&P 500 index. And it's really skewed, certainly in my opinion, and in the opinion of other financial analysts, the value proposition that you're getting from the index. If you look at it, only 100 companies out of the 500, so 20%, account for about 90% of the return of the S&P 500 index. In fact, there are 257 companies that had negative years last year, greater than 10%. In other words, they were down more than 10% for the year. Remember, the index was up almost 18% if you factor in dividends. So if we start thinking about it from what's really going on here, what you're really looking at is there's 5 to 10 companies that are really driving most of the return in the S&P 500. And what you've got is essentially a big tech momentum fund in the S&P 500. This leads to what we perceive as a dangerous concentration risk. And I think it's something that we definitely need to keep an eye on and are keeping an eye on. And it really is something that we try to diversify away with our investment strategies and the way that we manage our portfolios. And Darren is going to get into that when he does his presentation. But I do think that it's important to understand that the S&P 500 is no longer really an index that represents 500 companies. I mean, it's essentially 10 companies that are driving most of the profit in the S&P 500 at this point. Touched on briefly a little bit of the monetary and fiscal policy decisions that the federal government made to help bring the country back from the brink. And we've got another slide after this one that kind of shows that in numbers in terms of how the economy fared during the 4 quarters last year. But this slide is interesting because it shows that the Fed funds rates were going up as our economy was booming and we had the threat of potential inflation kind of creeping up. But it did start to stall about mid-2019. And as a result, the Fed had already cut rates 3 times before we even got to 2020. And then when we got into 2020 and the COVID catastrophe happened, we really saw aggressive rate cutting as the Fed tried to shore up the credit markets and also shore up the economy in general. And we dropped rates essentially to zero. The federal funds rates were dropped to zero, as this slide shows. Truly unprecedented in the history of the Federal Reserve. These were some of the economic indicators that I mentioned. I think that if you look at GDP growth, and GDP stands for gross domestic product, for those of you who may be questioning that, we had a brutal Q1, and Q2 was truly brutal as economic activity came to a standstill. In fact, most of that, the negative GDP growth in Q1 was March. I mean, January and February weren't that bad, but March is when the tailspin started, and it certainly continued throughout the second quarter. And then we came roaring back in the third quarters. It looked like we were kind of getting a hand on the virus, and all of this federal stimulus got pumped into the economy, not just the $2 trillion, but also the different, the CARE Act, the PPP loans, all of the different things, the reduction in interest rates that they were doing to drive things. The labor market, these are unemployment rates. Our unemployment rates had been hovering in 4% range until we got into 2020. And then starting in Q1, we started to see that tick up, and we actually got above 10% for the first time in a long time in Q2. And it has remained elevated. I think we're going to have some challenges in getting the employment rate up to where it was pre-COVID. So that's something we need to watch. Inflation was pretty much dormant for the year, which was a bit of a surprise, but it's one of those things that Darren, I think, is going to probably expound upon some more. With all this stimulus in the markets, we think that inflation is probably going to start ticking up. I don't want to steal any of Darren's thunder, but he'll talk some more about that. Consumer confidence was very high. 100 is kind of the baseline. I think they started tracking this in 1985, and they use 100 as being the bellwether baseline. Anything above 100 is very good. And when you get below 100, those are cause for concern potentially. And we did dip below 100, and we've stayed down there. So consumer confidence hasn't fully recovered from the COVID situation, and that's something that we've got to keep an eye on. And manufacturing just went into a tailspin as there were lockdowns and people didn't want to go into to the office or to the factory to build things. And we had a real problem with our manufacturing growth. In fact, it was all negative throughout the year and didn't recover until we got into the fourth quarter. And it's just slightly coming back. But hopefully that will get better as we get past the COVID crisis. All right, where are we now? As you know, Darren and I love to talk about the speedometers from City National Rockdale. It's a venerable old investment firm that looks at economic indicators, and they publish them on their website in the form of 20 speedometers that we reference and use. In fact, this is one of the components of our all-weather indicator matrix. And as you can see, at the beginning of 2020, things were okay. This is the January chart. We had some positive speedometers indicated by green, and we had some yellow, which are kind of a moderate level of activity in some areas. You know, the yield curve being one. Housing and mortgages were kind of in that moderate area, and the political indicators were all negative, red, and they stayed red really throughout much of the year. Let's switch out and take a look at where we are now. This is the chart from I guess this month, February, and if you look at it, lots of green, some yellow, and no red at all. I'm not sure I quite agree with that. I still think that some of these political indicators should still be red, but who am I to argue with City National Rockdale? These guys have been doing this for at least 50 years, and they've been pretty successful at interpreting the economic winds. So I think the picture actually is fairly bright, based on what you see on this chart versus what we had on the previous chart. If you look at that, we've moved from really kind of a moderate, steady as she goes to everything is looking much better. So I think that's pretty much where we stand now. I'm going to turn this over to Koki so she can talk to you about risk-adjusted performance. Koki?
Hi there. So I think you can hear me. Actually, there I am. Great. Hello, everyone. Thanks for joining, whether you're, like Darren said, internationally or West Coast or East Coast. We thank you for joining us. I have a very lengthy portion of today's presentation. Is one slide. And this is a slide, I'll date myself, that I have been drawing for clients and discussing for now 25 years. Yes, it's true. And it has to do with risk-adjusted returns, as Armand, introduced. And the reason why this is, I think, very important is because, albeit most investors would say that the most important thing to investing are their returns, I know that there's altogether a different picture, and this picture sort of says it. And the picture talks about managing risk. So So I believe that investing, we believe as a firm that investing is all about managing risk. And, I want to quote one of my favorites, who also dates me, is Warren Buffett, because, if you've ever followed Warren Buffett or heard any of his great wisdom, I think one of the better things that he's shared with the world is that the rule number one of investing is to never lose money. And then the second rule is to never forget rule number one. So, that being said, all joking aside, just going back to this idea of risk, when you take on too much risk is when you do lose money, right? So what I wanted to highlight in this slide is, and ask actually all of you who are tuned in, and again, thank you for your eyes and ears tonight, is this question. And I'll just tell you, it is a trick question. But so the question is that there's two scenarios of two investors, and each investor earns 8.5%. And this is what this slide depicts. And I usually am, no, I'm not dating Warren Buffett, but thank you for the comments as they come in. So each investor earns 8.5%. Is either of these two investors, and I'm going to do the pregnant pause, but is either of these two investors better off? Again, they each earn 8.5%. And the question is either better off than the other? So most people answer the question no. They each earned 8.5%. And I posit that absolutely one investor is better off than the other. It's the investor who is investor B on the slide that has the very gradual red line that goes from one end to the next. And investor B, again, earns 8.5%. So would you rather be investor B who earned 8.5%, or would you rather be investor A who did all these ups and downs and ups and downs and ups and downs throughout the year? So not that this is terribly analogous to 2020, because most investors had the up and down and the up and down over the course of the year. But I think that what you should know is that we are doing, in the back scenes of your portfolio, is we are analyzing risk-adjusted returns. And so, I guess one example I'd love to give you is a ho-hum stock that's in your portfolio, and it's Walmart. And the best measure, by the way, of risk of what depicts in the slide of these returns, the way to truly determine how is your portfolio doing, is a risk-adjusted return. So if Walmart, for example, ho-hum Walmart earned 21% last year, and Armin just mentioned that the S&P 500 was up 16 to 18%. Are you better off if you're a Walmart investor? Well, yeah. Let's pretend that the returns were about the same. They're pretty close. But the truth is that the standard deviation of Walmart is much lower than that of the S&P 500. And it has to do with exactly what Armin highlighted, which is the fact that, the top 10 stocks make up 30% of the S&P's makeup. So I think it's very important to know that we're striving ever hard as an investment committee and as a firm to consistently analyze the portfolio to, make sure that your risk-adjusted returns, that we're not taking too much risk at any one given time. And this is very much highlighted. If you've looked at your returns over the course of the last year, yes, you will see that we de-risked most portfolios in Q1 and Q2. That was really important because for those of you who are retired and or taking withdrawals on your portfolio, taking unnecessary risks when we are in the midst of a global pandemic and by all means headed into a global recession makes no sense. Now, for the investor who has a 10, 20-year time horizon, it makes perfect sense to not de-risk a portfolio. So for the client's portfolio that we did de-risk, their standard deviation or their gyrations are going to be a lot less than, say, someone who did stay fully invested. And so I think the key here is making sure that you've checked in with each and every one of us or with your advisor, just to make sure that you are invested in the right models that's commensurate with the amount of risk you want to take, whether it be our I don't want to call it our newest flagship model, but our all-weather portfolio, which is going to de-risk and re-risk you, or whether you should, park it in, our moderate or our aggressive portfolios. The point being is that with our tactical models and with this just ever vigilance to a risk-adjusted return, so that we can make sure that you're the investor that gets the slow line 8.5%, as opposed to the up and down 8.5%, where you're now losing sleep and you have ulcers and you're worried about the market and having to manage all these emotions. We're hoping to get you to that point where you're investor B here on the slide and getting you that same return that somebody else might also be getting, but they're taking more risk. With that, I think it's important to close with another Warren Buffett quote. And it's kind of a long one, but I think it takes the idea of all of the risk that we saw in 2020, and most of us were around in the 08-09 market. And the quote, and I'm going to read from my screen. In the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Great Depression, a dozen or so recessions, and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet, the Dow rose from 66 to 11,500. So with that, I say quiet the noise, and I will pass the baton to Darren.
Thank you, Koki. I appreciate it. I was going to be really impressed if you had given that quote without reading it from the screen. I actually was all prepared to say how impressed I was.
No,
I'm going to remember.
Lots more things better to remember.
All right, so I get to have a lot of fun, and I get to look into the crystal ball. A lot of people ask me my opinion, and almost every time when somebody says, Darren, what do you think is coming next? They follow with, I know there's no such thing as a crystal ball, but what do you think? Well, I'm convinced that I have a crystal ball. It's just a little murky and isn't crystal clear, but I've got some insights. So tonight I want to give you some thoughts of not only what we see coming, but the why behind it. So if you are on our update in August, 6 months ago, you heard me talk a lot about a theme, which is don't fight the Fed. And that's still, first of all, played out the last 6 months. A lot of people have asked, well, how is it that the market has gone up so much the last 6 months with all the uncertainty and all the COVID cases and all the crises and all the political unrest? How is it that the market has gone up so much? Well, like I said, it's exactly what we talked about 6 months ago, which is there is so much extra money in the system. You can see on my slide here that on average, going back to 1995, the money supply, so M2 is literally how much cash is there in the system, has on average gone up 6% a year. Last year, it went up almost 26%, 4 to 5 times more than normal. Where did that come from? It's $4 to $5 trillion of stimulus money. It's all the extra unemployment checks, the personal checks, the payroll protection program, et cetera, et cetera, et cetera. There's probably at least another 1 to 2 trillion coming, and maybe 3 more trillion coming. With all of that extra cash in the system, that has driven the market up the last 6 months. In fact, you see kids getting checks that they have nowhere to spend. So what do? They put it on Robinhood and they invest in what else? GameStop or whatever the hot stock is on Reddit. And if it's not that, they're having fun on Robinhood. And I think there are pros and cons to that. I was talking to a client yesterday, and on one hand, I see young investors getting into and being curious about investing in a way that the previous generation really wasn't. The previous generation, and by that I mean maybe a decade earlier, saw the bubble burst in 08, 09 and was afraid to invest for 10 years. So I like that curiosity, I like that intrigue, but I also think that right now there's a lot of gambling going on, and with the market kind of going up, no matter what you put your money in, I would say that a lot of young investors are getting in and thinking that it's easy. So pros and cons there. But I think this slide of all slides really tells us why the market's gone up and is one piece of the crystal ball looking into the future. So when we look back at the last year and three important components that are a consequence of all that extra money, the actuality, 2020 versus the year prior, earnings were up $1 trillion more than 2019. Now, how is that possible with all the restaurants shut down, all the transportation, airports, airlines shut down? How is it possible that earnings are up? Well, it's the combination of salaries and regular earnings, along with all the stimulus money, other income sources. So an extra $1 trillion, along with, I don't know about you all, but I had trouble spending as much money when COVID first hit. I spent a lot of time down in my basement here, couldn't go out to eat, couldn't travel, went to Costco once a week and loaded up on water and food, and that was about it. So while earnings were up $1 trillion, spending was actually down $500 billion. Putting that together, savings was at all-time highs, $1.5 trillion higher last year than ever. There is more cash in people's pockets and less debt than ever right now. Now, I'm very sorry if you or somebody you know or your family is in a situation that isn't thriving or surviving through this, that's having challenges. But overall, as an economy, actually people are in better shape. Again, overall, yes, there's a great divide. There are some people that are profiting immensely. There are some hedge funds and private equity and just big investors that were able to take huge advantage. And yes, there are people struggling and suffering. But overall, as far as we look at the overall economy and market, there are some positive signs. Okay, what does that mean for the future? I don't expect you to read this whole slide. I am not going to read it to you. It is just there as a placeholder for me to talk to you about inflation. When there is that much extra money, when earnings are up, spending is down, you have less demand and more supply, more money to spend and less places to put it. That eventually feeds into rising interest rates and inflation. Now, I don't know when that's going to come. I do know that inflation has already ticked up. Inflation now is higher than it was a year ago. It was higher than 6 months ago, by a full 1% higher. So we've already seen the beginning of it. None of this becomes a problem until we really see significant inflation. But when we do, when we see real rising interest rates, which is going to cause the bond market to bubble to burst, and when we see inflation create the cost of goods to be much higher, that's when we're really going to see discomfort in the stock market. Until then, you probably hear my theme is pretty positive. I'll wrap it up in a bow. So watch for inflation, keep an eye on that. Like I said, it is ticking up. The 10-year treasury right now is a full 1% higher than it was a year ago. When it starts to get to 2 and then certainly 3%, I think the winds will shift. All right, this is, I thought was a really intriguing chart that I was able to come across as far as what track we're on and when it looks like the timeline of when most people will be immune to COVID, at least on the track that we're currently on. If you look today, most of the immunity comes from already having been infected. So you can see right about 30% of the population is immune at this point, with very small component of that being vaccines. But you can see that over the next few months, the blue line is growing until we get to about midsummer. They expect that between the vaccine immunity and immunity that came from being infected, we expect to cross over the 70% of the population point. So that is positive news. When you take all the extra money with low interest rates, with the world opening back up because of people hopefully getting immune, then that bodes well for the economy and the market. There are uncertainties that are mentioned here, right? We don't know about other strains that might come out. We don't really totally know how the vaccine is going to work. We don't hear a lot of talk about treatments. I said back in August also, I'm really focused on treatments. But right now, it looks like things are heading in the right direction, finally. One of the questions that I get more than anything else is, Darren, the market has been so hot. It's at all-time highs. Is the bubble going to burst? Are stocks overvalued? When, should we de-risk? That's one of the questions that came in. There's a couple of ways to look at it. The slide I have up here looks at price earnings ratio, PE ratio, which is the most traditional way to look at stock valuations. And yes, valuations are higher now than they were a year or two ago. not severely high, right? So right now we're slightly above the yellow into the red. So stocks are slightly less attractive on a PE ratio basis. But there's another component to that. First of all, we're not yet so high that we need to be concerned. If you look back in history, so right before the 2000 and 2002 bubble burst, we had PE ratios of 25 and above. Okay, PE ratios, by the way, takes the price of all the stocks in the market versus their earnings. And when the price is too high relative to their earnings, that's a sign of trouble. So it's trending up, but not quite as high as it was in 2000. Also, you'll notice that when the bubble burst, not really the bubble burst, when the stock market crashed in 08, 09, PE ratios were actually pretty low, but that was a credit crisis. That was a whole different game. It wasn't based on stock market bubble or anything else. It was purely, not purely, it's a big deal, was the credit crisis, the housing crisis. Okay, so while PE ratios are high, the other component that's not talked about a lot is you need to consider what current interest rates are. PE ratios just look at the stocks and valuations themselves. You have to compare to what are the other options. So right now, with interest rates being so low, making bonds extremely unattractive, when you look at the chart here, what you see is actually a very inexpensive stock market, because where else are you going to put your money? You can't get money in the bank. You can't get it in CDs. You can't get it in money market. You can't get it in bonds. And not only are you getting a low yield on bonds, but when interest rates do go up, the value of those bonds is going to go down. So the reality is sticking your money in bonds right now is a losing proposition. It's just a question of when. We don't know exactly when that day is going to be, but right now it's a losing proposition. So that, even though PE ratios are a little bit high, when you compare that to the current interest rate environment, it actually makes stocks relatively attractive. As far as probability of recession goes, I like this chart because one, it gives us a baseline where when you look back, the reality is under most circumstances, there's about a 30% chance of a recession. It's never zero. You could see here that when the probability was above 50% heading into 08, the recession came. We had a 2-3 year recession then. It tipped slightly above in 2011, but never crossed over and never caused the recession. We had a big jump, of course, when COVID hit. That was sort of a different kind of recession, right? It was very sudden, very quick, a big spike, but then came back down. And now as we sit here today, we're actually sitting in a position of a very low chance of recession. Again, back down to the 30% range. So when I bring all this together, I mean, not go to that slide yet. I take lots of cash, lots of savings, less spending right now, low debt, corporate America with tons of innovation and research and development and new ideas in manufacturing, technology, healthcare, et cetera. You take vaccines and treatments with number of cases decreasing. Actually, one chart I left out is right now the number of cases are down about 50% from a month or two ago. So very significant. Obviously, you know, there's still a ways to go, but it's trending in the right direction. So you take all that, meaning that we're hopefully soon going to be back to meeting in person, dining out, traveling, and spending money like we used to. I would say my personal opinion is there's about an 80% chance that the market and the economy continues to go up the rest of this year. Armin's probably cringing. He doesn't like specific forecasts. And actually the 20% that I leave is because we don't know what we don't know, right? We didn't know that COVID was coming before COVID came. We didn't know that airplanes were going to crash into buildings in New York and other places in 9/11 before 9/11 came. So we never know about the black swan events. And that, you know, for that reason, you can never say there's a 100% chance the market will go up. You can never know for sure. But so I do have a high level of confidence. I want to segue and wrap up before questions with a little bit, actually a lot of the changes that we've made in our strategies and what we're doing now and to be prepared for the future, including we're more prepared for a black swan than ever. So I'm going to jump. I don't know how well you can see this slide. There's a lot on here, but there's a couple of strategies I really want to focus on. Towards the bottom, you may see our tactical AI strategy, AI, artificial intelligence. So we are now using an artificial intelligence strategy, which the great thing about that is several, but one is it's constantly learning and adapting. And one of the things that they did right in the middle of, I keep saying the pandemic, but it's still going on. When the pandemic first hit, those first few months, the model learned and adjusted, and they added a black swan signal called the Swan Guard. So we now have a SwanGuard signal that says, hey, something's happening here. We need to make a change and an adjustment. That artificial intelligence also, after the market had dropped 30% or more, it triggered to say, even though things still look bad right now, the market is oversold, and there was an overriding signal to say get back in because of the constant machine learning and adapting. So that is a model that we've added that we're very excited about. We've added it to the all-weather scoring as well. The nice thing about that, and we've changed the relative strength model to do what we call it breakaway stock. You'll hear me use that term. Both of these are what I would call more fast twitch models and signals. So we try to balance being fast and slow twitch. We want to be fast enough to really get out of the way if the market's tumbling, but not so fast that we miss a quick rebound. So we've got to balance that. But these are both fairly fast twitch. And the biggest change, I would say, is historically, while we've had signals and indicators to tell us when to make adjustments, when we've been in the market, we've pretty much bought the market historically. Now with these, we're much more focused and concentrated. So the artificial intelligence model, when we're in the market, in that model, it buys the #1 sector ETF that it sees. So right now today, it's in a next generation internet strategy, ARKW it's called. Last month, it was in semiconductors. Last 2 months, it was in semiconductors. Before that, it was in innovation and technology. But at the same time, this model can go to cash or bonds or other alternatives, commodities. So the nice thing, again, is not only can we get out of the way, but also when we're in, we could generate what we call alpha or return above the market by being much more concentrated. Breakaway stocks similarly doesn't use artificial intelligence, uses a different boss signal and a bull bear indicator to determine when to be in the market. When that one's in the market, it ranks the 500 stocks in the S&P on what's called a moving average distance, what's moving the quickest. I like to pretend they're all arm wrestling each other. And then it buys the 7 top stocks in that ranking. So again, very laser focused, concentrated to generate alpha when we're in the market. We also de-risked our income strategy. We've worked hard over the years to avoid traditional bonds because of the interest rate environment. At the same time, we don't want to accidentally tip into being too aggressive. So we've de-risked that. And then lastly, and most recently, we've enhanced and updated the economic model using the same signal, using economic indicators. And that model has worked. There's nothing broken with it. But what we realized is, just like with the others, why not, when we're in the market, why not buy the best, in this case, style and sector, not style and size. So we're looking at large, small, mid caps, international growth value. Right now, we're in small cap growth. So those are some changes that we're very excited about. Frankly, they've worked very well the last 8 months. We are excited that they'll continue to work, and we certainly feel as and more prepared than ever for all different conditions. The up market's been great, and prayerfully, when the next crash comes, these faster twitch and StormGuard signals can get us out of the way. With that, if other questions come up, go ahead and put those in the bottom. We had some come in that I'll start with, and Armin, you can come up and join me to answer the questions that I can't answer. Like to give him the difficult ones. I'll answer the ones that I think they'll tee me up. So let me stop screen share. Okay, first question, and I'm going to take this one.
Go ahead.
Should we get more conservative in our investments? By the way, I'm going to go through pretty quick because I don't want to keep you all too late. I think you heard in my message, the answer is, as long as we're in your risk profile, I wouldn't adjust based on current conditions. I actually think the sun is out right now. I think things look rosy, and I'm not saying you should be more aggressive than you're comfortable with, but within your risk profile, I would not de-risk right now. I think things are still poised to do well. At the same time, we're positioned if things adjust along the way. I'll take one more, then I'll give you the next one. I think you asked me to take this one. Is there or will there be any cryptocurrency exposure in our portfolios? The answer is, certainly for now, the answer is no. And there's a couple of reasons, but there's really one main reason that I want to point out. And I say for now because you never know in the future. We can and are able to offer any investment strategy out there. You know, I like to say that if treasuries someday are paying 18%, we can put your money in 18% paying treasuries. When it comes to cryptocurrency, my personal biggest concern, I think Armin shared this as well, is the lack of regulation. I don't think we should be investing in something that has no regulation. And the reason is, number one, it was essentially created to have money that's not trackable and can be used for purposes that are not very healthy for the overall economy. Not saying all people use it inappropriately, but it was designed for that. And second, because it's unregulated, either the government one day could say, we're going to regulate that now, which will cause the value to drop. Or frankly, there's a possibility that one day they could say, we're shutting that down, it's unregulated, and we're not allowing it anymore, and it becomes relatively worthless. So those are a couple of reasons of several why we won't touch cryptocurrency, at least for now. It could change in the future. All right, Armin, this one's longer. Given the new administration's planned spending and tax increases, what impact will the debt load have on the dollar and inflation?
Well, I think Darren actually touched on this somewhat. If you think about what historically has happened when the government has pumped money into the economy, inflation has been the result. We've seen inflation starting to tick up, and I think we're going to continue to see it tick up as the money gets into the system. So I do think that we're going to also see a devaluation of the dollar. That's already starting as well, particularly vis-a-vis hard assets. And going forward, we're probably going to have to look at things that combat that, things like commodities, which tend to be good inflation hedges.
Thanks. I think we're going to hand off to Koki for a second. She had a question she saw that she'd like to answer, right? Koki, you want to unmute and you can take it?
Thank you. You got me? Great.
Yes.
So Travis had 3 really good questions, and I think I want to take them backwards just to be Koki, because I really wanted to address the love of Buffett. I just think he has a lot of street value and market appeal, but if you know me and the 25 years of passion in this industry, the least of what I do is what Warren does, which is fundamental analysis. So I don't even know about this Buffett indicator, but I would say that I rely more heavily on technical indicators. And that speaks to, Darren mentioned the sailing and the rowing, and he had that slide. And the rowing, the tactical part of our portfolios, which really relies on super specific technical indicators that have been around since, say, the 50s. Those guide us. Those give me sleep at night. Those help my decisions as an investment committee member. It helps guide a good bit of our tactical portfolios and our decisions within the overall portfolios. So not a Buffett confidence indicator. And if it's at a record high, that means nothing to me. Just like Tesla being at a record high means nothing to me relative to the market. In fact, I will say that our technical indicators, I don't want to get too wordy, but our high-low indicator, which hit above 98% in November, historically it hadn't happened, but maybe 9 times since the 70s/80s. And on a 9-month forward and a 12-month forward basis, you saw double digits on the S&P 500, even with the indicator getting that high. That indicator has steered us right this year and over many years. 08, 13, even more than that. So I'm blanking on some of the other more pivotal years, but I think that's a good transition to your other questions. I'll go with the expected impact, and I'm sorry I wasn't reading the question. I don't know if viewers can see it, but can I expand on the expected impact on unemployment? And has today's posted unemployment metrics changed the outlook at all? So what I'd like to say about unemployment, and this will go hand in glove with Buffett being fundamental and us for the most part being fundamental and tactical, but I'm really more of a tactical gal, is that unemployment is a lagging indicator. Whereas the stock market, where the stock market is today, is a forward-looking indicator. So the fact that the stock market is going up is a really great indicator to say that no, the unemployment rate is not going to be affecting our outlook. And as evidenced in the National Rockdale slides in tonight's presentation, many economists also agree with that and don't see a dim outlook for the stock market vis-a-vis that of the unemployment numbers. And then lastly, Travis, and thank you for chiming in. Do you believe that the low rates as set by the Fed has increased the theoretical value of stocks currently? And, you know, I think Darren's addressed this, but there is a high, albeit interest rates are not directly connected with the stock market per se, you can look to the past and see a pattern, and that when there are low rates, there are typically corresponding high stock market returns. So I hope that addresses unemployment, the theoretical value. Yes, I do believe it increases the theoretical value with low interest rates, and history supports that. And no, to your question of with my love of Buffett, does the Buffett indicator being at a record high inspire low confidence in the market continuing on a similar path seen in Q3 and Q4 and potentially taking a turn? No, I don't see a turn in the offing. It doesn't mean a short-term exhale or hiccup won't be coming. But not only do our tactical indicators say all things great, but actually our fundamental and our economic indicators are saying that the future looks bright. And with that being said, and this will be my last comment, I like to think that we're agnostic. We're stock market agnostic because of our sailing and rowing strategy. We have no impetus to say, oh, we think the future is rosy, because, you know, our technical indicators and our tactical models will take us to cash or bonds or gold. So, you know, actually when markets don't necessarily do very well and say it's not a black swan event, we have forward-looking indicators that help us sidestep those. And so those are actually really typically shining spots for us as asset managers. So thank you for letting me chime in.
Yeah, thanks, Koki. I'd like to add two things. Travis, first, this is going to make it three things. Travis, I think your questions are wise and insightful because yes, while the Warren Buffett indicator is high, which usually means a sign for a downturn in the market, actually, because of what I talked about and Koki reiterated with the high money supply and low interest rates, I think the Warren Buffett indicator is sort of falsely indicated right now. And then, yeah, the biggest risk, you know, to the market will be when bond interest rates become high enough that there's a good alternative to bonds, to stocks. Sorry, that's when they really become a problem. So I agree with that completely. And like I said, I think the questions were well put. A couple more, Armand. Will Wealthy P invest in any Reddit meme type positions?
No.
Thank you. That's the shortest answer Armand's ever given. What industries, markets are we most bullish in right now? I mentioned that we're very focused in the next generation internet. We've been in semiconductors. I think all the innovation technology right now. The question as I read it was probably looking more a year forward. And frankly, you know, we're certainly not day traders, but we really are looking month to month. We aren't really looking to see what's going to be the hot, you know, sector or stock in 6 months or 12 months. But right now, internet and semiconductors have been the place to be. You can choose to answer this short or long. Does Wealthy P ever invest in shorts, puts? It's actually similar to the cryptocurrency question. You know, go ahead.
No.
And you know, one of the things I'll elaborate. There's a few reasons why, and you know, one of the things we found is with tactical signals and tactical indicators, you know, as long as we're right 70 to 80% of the time, we'll tend to do better than the market. But if you start going inverse and leveraging, you add that component, you actually have to be right a much higher percentage of the time because the wrongs could be much more painful. So there's several reasons why, but that's one that may not come to mind. And
there's also regulatory issues there, Darren.
yes, there are. Let's see. I think that one or two more may come in. I'll just open them here. Justin's giving me a signal, but Jeff mentioned ARC W was mentioned. Aside from performance, how important is someone like Kathy Wood and the level of transparency she provides about ARC investment ETF investment choices when you select an investment fund for your clients?
I've actually spoken with Kathy Wood. She was on CNBC the other day. She's very impressive. I like the approach that ARC takes with their funds. We've looked at several of the ARC funds, and I think that they're real innovators in the ETF marketplace. They basically use people at ARC that are very familiar with the industries that they're selecting stocks in. So these are people like in their biotech fund, they have people that worked at biotechnology companies, are physicians or PhDs that very much understand the technology that they're investing in and the companies that they're investing in. And that's been their approach. I think the ARC funds are quite exciting, and we like the fact that the artificial intelligence algorithm that we use selected ARCW.
Yeah, and actually, so that artificial intelligence model looks at over 100 different ETFs or sectors. I picked ARCW this month, and it was in ARCK before, which is what, innovation technology.
Yes.
So those have paid off nicely, and but at the same time, that artificial intelligence model can take us elsewhere. So great question. Thanks for that. If there are follow-ups, feel free to reach out to us. If there are any slides that you'd like, we'd be happy to share those. This will also be sent out and put on our website, so feel free to share it with your friends and send them to the website to watch the recording. I know a couple of people also mentioned they had to leave early, and we're hoping to see a recording. So we will get that out for sure and post it on the website. We look so forward to gathering again in person. Hopefully the metrics I gave you earlier are true, and we'll get across that 70% figure. And I will share, we're just kind of taking one event at a time, not thinking too far ahead. And we have, at least for now, decided that our golf event will be live. Sorry if you're in Charleston and not coming to the Atlanta area, but that one is in the Atlanta area, May 27th or something like that. So we look forward to that. So grateful you could join us. Reach out anytime if you have questions. And we just hope you had a good night and got something out of this. Thanks so much. Have a good night.